Howdy there, folks. Welcome into tonight's video. It's a buy one, get two free in this one. 3 videos for me to react to. First one up here from 3 hours ago. Markets have ignored recession signs only one time before. I want to watch that one, react to that one, give my perspective there. Second video up here is one from 5 hours ago. Earnings are going to be better than expected. I want to hear what Stephanie Link has to say. Why does she feel like earnings are going to be better than expected? We're about to get into massive earnings season over this next 3 weeks. It really starts this week, to be honest, in terms of the massive amount of earnings, and really continue on for the next 3 weeks. It's just earnings craziness. So hear what she has to say, kind of share my perspective. And third video to react to, this one's from 4 hours ago. The sky isn't falling, says Ed Yardeni, in relation to the bullish markets that we've been into, right? And he's still bullish on the market. So want to hear what he has to say. Yardeni, I love the Yardeni charts all the time. Sometimes I pull those up for you guys, forward P metrics, price of sales, and all those different metrics. So appreciate everybody joining me as always. Thanks for being here. 25,600 plus subscribers, if not 25,700 plus subscribers. So thank you everybody that's always joining us on the channel and subscribing. I appreciate y'all. If you ever want to say hi, by the way, to me, send me a DM on Instagram. I try to get back to a good amount of people on there. Financial Education Jeremy. I always have it linked. I think it's linked in the description area, but you can just search me on Instagram if you want to ever send me a message on there. Alrighty, guys, let's get into this.
The market right now might be ignoring all warnings of a recession. According to our next guest, it's not the first time that's happened. Lori Calvasina is head of RBC's U.S. equity strategy. She joins us here on set. So this goes perfectly into the question that prompted you to write the note, and that is, has the stock market ever priced in a recession before it's happened?
Right, and we've been getting that questions from investors who are frankly, I think sort of feel like Dan, but are looking at the market action and saying, why are we higher? What's the bull case? And we kind of walk people through what we think the bull case is. And then people say, okay, fine, but we haven't even seen the recession start yet. So how can we possibly have priced it in? And look, we've gone back and said it would be, it'd be odd, but there's some precedent for it if you go back and look at the history books. If you go all the way back to 1945, that was the recession coming out of World War II, stock market just marched through it. It's the only recession where it's essentially been ignored. And I think that there are a lot of differences between today and that time period, but there's some similarities as well.
So that's the only instance?
That's the only instance.
That's all you got?
Not convincing to me if it's one instance.
Wait a minute. Oh my gosh. This cracks me up. They laugh about that. So funny. And yet, do they even think to themselves, what if the economy doesn't get hurt bad? What if we don't see unemployment go to 7, 8, 9, 10%, like all these experts are always predicting? What if we don't see that? Have we even considered that? What if unemployment stays in the 3s and 4s? What if inflation gets under control, as it's been starting to get under control, right? What if that continues for the next 6 to 12 months, right? What if the consumer gets in a much better place over the next 6 to 12 months than they've been over the past 6 to 12 months? These are all things you have to consider. You can't just laugh this off and be like, oh man, it's the end of the world. Why is the market doing this or something like that? It's absolutely ridiculous, but I see these Wall Streeters do it time and time again. And it's an easy thing to do when you've been bearish, you've missed this whole ride for the past 6 months, right? And you didn't take advantage of all the opportunities that the market presented us for 2022. And now you're hoping, wishing, laughing, and hoping this market goes back down, right? And it's just what we see playing out right now.
Such a long time period, and there are notable differences between that period and this period.
Well, I think what's interesting is people say, we've never done this. And I'm like, well, we've never done this, but we have done something kind of similar. And the thing that's similar is that you had this massive decline in the market ahead of it, about a 43% drop early on in the war. And actually, even after you had the mid-war bottom, you saw a 13% drawdown in 1943. The recession was not till 1945. And when I was researching this, I actually found some interesting terms that were similar. It was described as a technical recession, just being driven by the fact that the wartime economy was shutting down and we were pivoting to a peacetime economy. So this kind of idea of a manufactured recession that we were all talking about last year, you actually had it back then.
Also COVID. I mean, what are we calling that, right? I mean, that was so much like a war economy, if you think about it. And
yeah, but we threw $6 trillion at it. And that's why we had a rip-roaring market in 2021 and 2022. And look at what expected growth is. Look at where inflation has gone and likely to stay elevated relative to that. Look at what the prior 10 years that we had a GDP to the pandemic. We averaged 2.2%. And we're not likely to get meaningfully above that with higher prices, and rates are going to reset higher. So to me, I mean, I don't see anything about that comparison that makes any sense given where we are right now. And I think the pandemic really Look at you. You're looking at me. Why are you looking at me like that? Why are you looking at me like that?
Oscar the Grouch.
Oscar the Grouch.
If you go back again to this 1945 example, you had massive government resources that went to fuel the wartime machine, and that was pulled back in a hurry. We're kind of doing something similar this time around, both on the fiscal side and the monetary side. Also, unemployment managed to stay very strong back then, and that's kind of the other head scratcher in this environment. How in the world has it stayed so strong?
Yeah, but you don't really believe that. You're just playing devil's advocate right now, right?
Well, see, I actually
I
actually think that we priced in a recession back at the October lows, but I think people are tired of hearing that, and I had to have something else to talk about, frankly. And it's just, the idea that people.
She's like, bro, I'm just trying to keep my job here. Like, give me a break.
Well, we've never done this. We've never done this. It's like we've done something.
So why would they
similar.
have priced it in this time then? Because that may be right. In other words, and everyone's also saying, get me back to 3,600 on the S&P, and I'm a buyer with two hands. And I don't think they're going to be on the way down if, other than, well, Dan maybe, because he'll be covering a short.
There we go.
He'll be covering a short. But
Yeah, exactly. Exactly. That's the thing. Like, everybody always wants the market at a certain price, right? And a stock at a certain price. And the market doesn't work that way, man. Market doesn't give a crap what you want the S&P to be at, or what you want Tesla stock to be at, or Meta stock, or anything like that. The market's going to do what the market's going to do. You can get on the ride. You can look at the stock, say, is it a fair valuation? If it's a fair valuation, take advantage. But to expect that you can get screaming deals and they're going to last as long as you want, it's unrealistic. And then when you get those screaming deals, look at how few people take advantage. Look at how few people actually take advantage. You get the price, and then how many are actually buying it?
would we have priced it in when, in fact, it's the same question? We haven't done this before. I hear you, and this time feels so different on so many different vectors. We haven't seen the Fed hike this aggressively. We haven't come out of a place where the economy was waking up. But again, why would we do that now?
Well, look, we did it back in October. And if you think about what was driving us to those October lows, it was, oh, my God, the Fed is tightening. It's all these big chunky hikes. We're going to have a recession. It was literally the Fed and fears of the Fed causing a recession that drove us to that point. The other thing we saw pretty clearly was over the summer, the small caps were baking in a recession. They were baking in an ISM down around 39, if you look at the manufacturing gauge, and valuations were literally at the rock bottom of the historical range. So if you look through that lens first, it makes a little bit more sense that the S&P just had to catch up to where the Russell was over the summer.
Fair points there, okay? Next video up here. Earnings are going to be better than expected, says Stephanie Lane.
Not priced in, could result in 15+% downside. And even in an optimistic scenario of soft landing, upside is likely less than 5%. And that comes through short-term fixed income.
Yeah, well, there is an alternative, right, in fixed income. And this is why we have the problems with the banks and deposits, right, because everyone's shifting out into higher yielding assets, right, in CDs and money markets. So you've been seeing that all year, that there is an alternative now. And I think that's one of the reasons why actually we've seen a trading range in the market. But at the end of the day, you're right, it comes down to earnings. And not all earnings are going to be horrible. I look at energy, for example. Numbers have been going higher, actually. And that sector is well below the 20 multiple that Marco is talking about for the overall S&P 500. Financials, under 1 times book. Historically, that's been a great time to buy them. Yes, they have their struggles. But by the way, I thought the quarters from JP and Wells Fargo, even Citigroup, who can't execute consistently, all three of them were really good. And so to...
No. JP Morgan's earnings were not good. Those were unbelievably great. Let's not disrespect those JP Morgan earnings, okay? Those were highest level of phenomenal.
There are pockets. I think the consumer's hanging in there. We talked about retail sales last week, and I'm looking at the three-month moving average at 1.8% growth. Consumer is still hanging in. Are they going to hang in if we have a recession? Probably not. But as of now, look at the Atlanta Fed GDP number at 2.2%. That actually is not a recession. We're not there yet. So I think that there are pockets in the market. And as you know, I've gotten more balanced in my portfolio, owning some defensives, but certainly seeing some opportunities in the cyclicals as well.
How do you respond?
Yeah, Steph and I are super aligned on the energy sector. Expectations are really low. 2024 earnings are 20% below 2022. I don't think it's a huge inventory problem, and I think demand growth will exceed supply growth. So I agree there.
It's like 5% of the S&P.
Yeah, 5% of the S&P.
It's not going to be the determining factor.
No, but it was 11% of the earnings. So, I think it's a little chunkier than people think on the earnings front. On the banks, we probably differ a little bit just because I think some of them, I think I agree with you. You're buying below 1 times tangible. It's a good deal. But the question is, that's really the intellectually honest tangible, or is the growth going to be lower? So I think it's more mixed there, and I think there's more. I can dream more in other places. I'm probably most negative on industrials.
Now you're picking a fight with Steph.
Well, our work shows industrials now the biggest percentage of the growth universe they've ever been, and I think about mistakes I've made in my career. The dozens and dozens of mistakes I made, most of them, or a lot of them, are when I confuse structural for cyclical. And, you have an upward slope, you have a cycle over it. I just think maybe some of these things are over-earning. We haven't seen the slowdown. Sure, there's exceptions if you've got great exposure to agriculture, oil, and gas, and you can grow above GDP. But there's a lot of sort of widget makers trading at 19 times with high earnings expectations. So I think it's always, Steph's a stock picker, so I think it's always in the details which ones you're talking about. But I think
By the way, I just want to point this out. This is a little something random. I just love that you point out, I made dozens and dozens of mistakes in my investing career. And I just thought that was an important point because it was actually something I spoke about on the main channel, right? You're going to strike out sometime in this game. You're going to make mistakes. Don't fear those. Accept that that's part of this process, right? I gave an example in the video earlier today about being a baseball player and being too scared to even play baseball because I might strike out or something like that. You're going to strike out. You're going to make mistakes, right? It's not going to work out sometimes. You have to accept that. I've had to deal with that plenty of times over the past 15 years. I'll have several times in the future. I deal with that. There's no investor, there's no amount of experience that will prevent you from making some mistakes and striking out and missing it. It's going to happen sometimes. You have to accept that. You have to move on and say, I'm going to continue to play this game and I'm going to focus on getting as many hits and home runs as I possibly can in this game, okay? And just always remember that. And I appreciate him just sharing that perspective because too many times these Wall Streeters want to act like they're perfect. It just shows me they're insecure.
And I'm looking, if I compare to energy, I'm looking at high estimates, high inventory, high valuation. So I like that pair trade. They both benefit if everything's, reopening, and both get hurt if it's not. But I kind of think energy's a lot cheaper.
Steph, I mean, you are one of those who try and tell a more positive story around the industrials, albeit on a bit of a selective nature, but nonetheless, far from a sky is falling scenario in that group.
Yeah, well, as you know, in the last couple of weeks, I sold CAT and I sold Deere. And so I only own Boeing, GE, and I own Ingersoll Rand. And I've been adding to Ingersoll Rand over the last couple of weeks because I think it's a great play on onshoring. Boeing, you know why I like it. I think longer term, they are going to get their act together with the 737 MAX. For the most part, they have. They had a little bit of a stumble on Friday, but I think they'll be fine. Free cash flow is going in the right direction, higher. And GE is a play on that, given their engine. So it's very specific within industrials. But as you know, I sold some industrials and put it into a more balanced area like staples, like P&G and Keurig Dr. Pepper. Back to earnings for a second, Scott. I actually am in the camp that earnings are going to be better than expected. And that means, is that better than feared? Okay, I'll take that. I'll give you that, whatever. But to me, I think margins are going to hang in better than expected. Everybody is gloom and doom on margins. We know companies cost cut all the time. We know that a lot of them have pricing power. I think international growth is going to be stronger than expected and much more of a tailwind. And the dollar being weak will also help multinationals. So I think at the end of the day, earnings will come in a little bit better than expected. They're not going to be up double digits. I don't want to suggest that, but I just don't think they're going to be down 9-10% like some people are expecting. And that's why I look for opportunities.
Fair plays, Stephanie Link. Next one up to react to here is The Sky Isn't Falling, says Ed Yardini. I want to hear what he has to say in regards to this one. And by the way, she was talking about, she sold Deere, she sold CAT, and that was shocking. I mean, you guys saw the 5-year chart. I mean, usually you would figure CAT and Deere would move somewhat together, right? One's going to always outperform or underperform each other, but the fact that Deere was at, 168% gain on a 5-year versus CAT was at 46%. My gosh, what a divergence. And I know Deere did do a big acquisition a few years ago, which was an interesting acquisition, but it was, from what I remember, was a very debt-laden acquisition Deere pulled off.
Too pessimistic. Look, there's been a lot of pessimism about the economic outlook, about the financial outlook since the beginning of last year. I have said that I think we're in a...
And why does everybody think they can also forecast the economy? Dude, Do they not realize that like professional economists can't forecast the economy? Professionals, that's all they spend their time on. They can't even do it accurately. Warren Buffett will tell you, like, you know, they can't. Those folks can't even do their job right. But now suddenly everybody knows when an exact recession is going to come and what the economy is going to do and what GDP is going to do. And it's like, what are we talking about here, man? What in the world are we talking about in regards to that? That's a game you don't play. It's not you don't get paid to play that game. That's all I'll say about that. You don't get paid to play that game of trying to forecast, you know, what the economy is going to do and not do. There's no.
We've been in a recession since last year, but it's a rolling recession, and it keeps rolling in different industries. And all in all, it isn't adding up to an economy-wide recession. I think when it comes to Jamie Dimon, he started last summer warning us about a hurricane and how his bank was becoming more conservative, more careful, and advised investors to do the same. Well, June of last year, we made a low, and then October of last year, we tested that low, and it basically held. We were only down 2% below that low, and the market's been doing fine then. So I just quibble with the fact that somebody as influential as Jamie Dimon has been promoting pessimism when what he really should do is just focus on his bank results, and they were spectacular at the end of last week, just totally at odds with his pessimism.
I mean, maybe.
Okay. Let's go take a little conspiracy ride with me, baby, okay? Hop in the conspiracy theory boat with me and let's take a little ride together, okay? So, some would say there's a certain individual that is the boss of Jamie Dimon, okay? And no, it's not the board of directors of JP Morgan, even though that would technically be the boss of Jamie Dimon. Some would say the boss of Jamie Dimon is who? Jerome Powell. That's what some would say, okay? So let's say in this hypothetical scenario, that is his boss. Well, his boss wants people to preach against the economy, to scare people from spending, right? To not cause anybody to take any levels of major risk-taking right now in the market, because any of that works against what the big boss, Jerome Powell, is doing out there, right? He's trying to prevent, if anything, the spending, which is why they keep raising interest rates, and they kept raising them, right? And so there's a moment when Jerome Powell's going to be fine with people going out there and spending money and taking out loans and buying new cars and new homes and this and that. But that isn't right now, folks. That isn't right now. And so if you're on this conspiracy wave of Jerome Powell being the boss of Jamie Dimon, then you could be on the thought process of he's only doing what his boss wants, which is to scare everybody, to tell everybody, you need to tighten up. You need to be in a position right now of, security. Don't take risk right now. Don't spend money right now. Okay.
We should have listened to him, though, more closely when he said months ago that a hurricane was coming. And, maybe he was wrong on Mother Nature. I mean, maybe it was an earthquake, and that was in Silicon Valley Bank. And it could have been much worse.
As I just pointed out, he has talked about a hurricane. I think it was on June 1st of last year. And I think it was something around the middle of June that the market made a low. Then it had a rally. Then it took a dive on Powell's hawkish stance at Jackson Hole. But the October low wasn't really much lower than the June low. So I think if anybody listened to Dimon and got out, they've missed a pretty good recovery in the market.
You think earnings, by and large, are going to be better than most had expected coming into the season?
Well, I'm like everybody else. I was very surprised by the strength of the bank earnings, but it turns out that they're able to raise their deposit rates and still come out with increasing net interest margins. So I think that's really quite an achievement. And meanwhile, loans are an all-time record high. So that's weekly data. So we have yet to really see the credit crunch that has been much feared. And yes, the bottom line is, I think instead of maybe earnings being down 5 to 7%, they might be down more like 4 to 5% this in the first quarter.
I mentioned at the very top of our program about 30 minutes or so ago this new note that came out from JP Morgan's Marko Kolanovic. Because you're talking about making that low last October, which you think will hold, I want to read you and reiterate for our viewers who may not have caught that exactly what he said. In terms of whether a soft landing is going to happen or not, and even if it does, what that means. On the downside, even a mild recession would warrant retesting the previous lows and result in 15% plus downside. You just take issue with that out of hand?
Well, that's his opinion, and I've got my opinion. It's not something where we're battling each other. There clearly has been a tug of war between the bulls and the bears. I've been among the bulls, especially in late October. I thought that October 12th was the low. I thought there was way too much pessimism, as much pessimism in some of these surveys of confidence about the market, about as much pessimism as we saw back in March of 2009. And surely things aren't anywhere near as bad as that. And so it's my opinion that we're not in a recession, and we've been in what I call a rolling recession. I'm somewhat encouraged that the Fed staff is calling for a mild recession in the middle of at the second half of this year, because I don't think it's going to happen. So from a contrary perspective, I feel relatively safe with that.
Yeah, and the biggest thing that I think is the most overlooked in the market is the fact that many of the biggest companies in the world, and just many companies in general, have had the past, I would say, 6 to 12 months, right, to really look at their businesses and start to right-size these businesses, whether that means cutting down on software costs, whether that means, letting some employees go, whether that's reorganizing some departments, whether that's slowing down on hiring, everything like that, right? And they've really had a moment to really, because revenue growth is not very exciting right now. We're in it's called a slower economy, whatever you want to call it, right? And I think what's going to emerge is a lot more healthy companies. And you saw this actually in 08, 09. Companies emerged much more healthy coming out in 2010, 2011, 2012 than they were previous to the great financial crisis. And I believe the same phenomenon is happening now. I believe Amazon is going to be a much more healthy company over the next 2 or 3 years than they've been over the past 2 or 3 years. I believe Meta is going to be an extraordinarily more healthy company over the next 2 or 3 years than they were over the last 2 or 3 years. You don't always need your revenue to go crazy to have your net income increase in quite a dramatic way, which can increase your valuation, right? Appreciate everybody joining me as always. Thanks so much for being here, folks. If you want to support my channel and you want to support my content, do so on Patreon. That might be pinned comment down there to support me on Patreon. Also get to see all the moves I'm making in the market. Also, if you want to ever say hello to me on Instagram. Financial Education Jeremy. Send me a DM. Much love as always, and have a great day.